Hello, in this video I'm going to talk to you a little bit about the strategy implications in CapSim of picking a different strategy and how you might go about doing an analysis using the Capstone Courier of your competitors to try and figure out from round to round what strategy they might be pursuing. We've obviously talked in another video about the overall strategies, so I'm just going to review them here. Again, we've got 6 of them. I think in the video I only listed 5. I didn't have a life cycle, but we'll talk about those. And so the broad cost leader, you're broad, which means that you've got to attack all 5 segments. You are a cost leader, so you're going to attack all of them using cost leader type strategies. And remember that cost leader type strategies are basically strategies that are driven by doing things at a lower cost and then capitalizing on that by competing towards the lower end of the price range that your competitors are pricing at. Broad differentiator, again, you're in all areas, but you're competing on the basis of product features or specs. And so you would see that in all of those, you're trying to provide the best features that you can and make yourself stand out as being different from everybody else on those features. So you might see lots of R&D and a lot of repositioning. Being a niche cost leader means that you're attacking the segments where cost means the most. The low end and traditional means the most to the customers, and you're retreating from the other segments. Niche differentiator, you're retreating from the low and traditional segments that are cost sensitive, and you are attacking the 3 high performance and size segments where product positioning and specs make the most difference to the customers. In focus, you're attacking everything, but you're attacking it differently. You're attacking on a cost basis in low and traditional. You're attacking on a positioning or spec basis in high performance and size. Life cycle, you really only want to be the low traditional and high end ranges so that things sort of drift from high to traditional to low. So you're retreating for performance and size. In the low end, you're not really attacking, or at least it won't appear like that. You're really just defending what you have. However, over time, the traditional products that you have potentially drift into the low end. It may look like you're attacking because you'll start to have more products in the low end. We can talk about that a little bit more, but generally this strategy involves adding products maybe at different points in the high end and the traditional product, and then not really updating those products and just letting the customer expectations with regard to spec drift by those, and so they move from one segment to another without you doing a lot of updates. And the way you stay current in the high end is that you just keep introducing new high end products all the time and then letting them drift. So those are the broad implications. What we want to do now is to think about what that might mean in terms of the courier and how you would pick this out. And so what I've done is prepare this table, and I will post this as a separate document on Blackboard so that you can get to it. But I've identified certain things that are on the Capstone Courier, certain pieces of information on the Capstone Courier, where on the courier they are, and what you would expect from them if you were pursuing a particular strategy. And so the idea would basically be, and we'll walk through this with one product with one customer as an example, or competitor, but the idea would be that you might be able to just look at the courier, see what's going on with that particular competitor, and based on that say, what does that tell me basically about their strategy? Which of the strategies they're pursuing. So to that end, first thing we would look at is cash flows from investment activities. And we're going to look at just one competitor. So I've pulled a Capstone Courier for a demo that I've been working on. And we're going to look, in the very first place we're going to look in the financial summaries at cash flows from investing activities, the plant improvements. And what you're going to see in that, we're going to pick on a particular competitor at this time. Let's just pick on the, we'll say Digby. So Digby looks like they have spent a lot of money on investments. Maybe not as much as Chester, but they're spending a fair amount. And so if we go back and we look at our chart, we would look at that and say, okay, big negative early round, big negative, big positive. We're not seeing a big positive. We are seeing some pretty big negatives. And so at this point we would say, oh, they might be, and I'm just going to highlight them with a little green, they might be that, they might be that, they might be that. Okay, so those are the possibilities. They don't seem to be a broad differentiator just based on that. They might be one of these others. They're clearly not a niche differentiator. I've left blanks in some of these others because it's, it could go either way. This is not a great tell, but sometimes it's just a useful first start to rule something out. So the next thing we would do is look at the product segment information on the Capstone Courier in the product production analysis. This is your production analysis. So we're looking at the primary segment to see about our product. And again, we're looking at the D. And so what we see is traditional, low, high, 2 performance, and 1 size. So we're in round 3. It looks from that they are represented in all of the segments, but that they've got more than one product in one of them. And so if we go back and we look over here, we'd say, let's see, in most or all segments, in most or all segments. Don't see them abandoning segments here. So they might be any of these 3. So next we're going to go to abandoning. And again, they've abandoned none. That's just sort of to give you a little bit more, where might they go if they're going to be one of these other things. So then segments with multiple products. They had multiple products in performance and size. So not in traditional and low, so that's consistent with that. This is consistent with that. Consistent with that. So we're starting to narrow it down. We're starting to see some patterns maybe. Now we would look at the revision dates for their products, and what we're looking for are revisions within the current year on most products. If they're broad, revision dates beyond the current year if they're repositioning some products, significantly beyond the current year, again, repositioning, or within the current year. So let's go look and see what we got. Again, for this, the year that they're in, just so that you can check that, is 2018. So they don't have any product that has a revision date beyond 2018. They do have this low-end product, obviously, that they haven't revised. We don't read a lot into that because the low-end isn't a product that you need to revise a lot because of the age expectation. And so they clearly are not doing a lot of revisions to their products that go a long ways. That would suggest that they're not trying to reposition any of those products anywhere. So going back to our matrix, we would basically say, could be this, could be this, could be this. So we're pretty confident at this point already that we're probably not looking at niche, and we're probably not looking at life cycle. But we'll just keep going. So MTBF, we're really looking, is it the lower end of the range, higher end of the range, or consistent with customer preference? So it requires you to remember kind of what that range is. That's a little bit tricky sometimes, but basically you can kind of infer it from where they are relative to everybody else. let's see, they are seem to be at a higher level than most everybody else on the traditional. Their 1400 is at the high end of everybody on low. 24.5 on their high is higher, higher, higher. These guys are a little bit higher than them, but they're near the top end on their high. Their performance at 2700. They look to be one of the only ones. Let's see, these guys are there on terms of their performance. 1900 on size. Let's see, they're at 17. They don't even have size. 19, 16. So at their top end. So what we'd say is that pretty much across all their products, they tend to be the top end of MTBF. So that would be here, here. Certainly not consistent with preference. Let's look at their position, either towards the low end of the range, the high end of the range, or consistent with preference again. And you can look at this one a little bit different way. Yes, the data is in there, but you could also just go and scroll through. There's a little chart down here at the bottom that sort of shows everything, I think. See if I can find that. Yeah, here we go. So remember their product D, they're out towards the high end of the range here, 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 and kind of in the middle to the high end here, but certainly kind of in line with where everybody else is in terms of these, but keeping up on this and still in spec on this. And so in terms of that, we would say they're clearly not towards the low end of the range. Say they're generally towards the high end, You might say they're consistent with customer preference. Let's try that as well. Price, this is a lot of times the one that really sort of settles it for you. We'll go back up and look at their price, again in the production report, and where they are relative to everybody else. So $28.50 on the traditional makes them the high end of that. $21 on the low end makes them almost the most expensive on the low end. $38.50 on their high makes them higher than that, equal to that, higher than that, higher than them, equal to those. So they are the highest priced in terms of high end. $33.50 on their performance and size. So higher than that, they don't even have performance and size. So $33.50 here makes them higher than those guys. Performance and size, that's us. They don't even have performance and size. $33.40, $33.50. And so again, you're basically looking at them being towards the high end on price in pretty much every segment. So towards the, we're going to say towards the high end of the range. Towards the high end of the range. Certainly not consistent with preference. Let's look at automation next round. Show you where that is. And again, what we're looking for here is it increasing, or is it really not? Have they stepped it up a lot, right? If they're a cost leader, they're going to invest a lot in automation. If they're a differentiator, they're going to tend to say, let's keep the automation low so that we can keep the changes, make it easy to make changes. So let's go look at their automation, kind of relative to everybody else. Let's see. The low or the traditional automation that they have is not particularly high. It's not the lowest, but it's certainly not high. For the traditional, the low end automation that they have, only these These guys have a lower one than them, so they're kind of towards the low end of that. 3, 4, 4, 6. It's a little bit of a mixed bag. These guys have gone a little bit lower than them. These guys, again, aren't in those segments. So they're doing a little bit with automation there, it looks like. These guys are doing a lot more. So they're kind of in the middle of the pack, we would say, in terms of automation. So let's see what that tells us. They're probably not this. They might be this. Doesn't look like they're really increasing that a lot. Limited in all segments. We'll say that. Increasing. They don't really fit either of those. Capacity, again, what you're looking at is, are they really, do they seem to be growing their capacity? Now, this one's not, it's probably more telling when they're shrinking capacity in an area or cutting it down to nothing. Because, they may just be right sizing, but since we're at round 3, they should already be sort of right sizing. And so now you're looking at, kind of how much capacity versus everybody else. It's sort of a signal of whether or not they think they're going to have more sales or not. And so if we look at their capacity, they got 1,000 units here. These guys are higher than them, a little bit higher, a little bit higher, higher, lower in traditional. Now, a little bit tricky here because these guys have a whole bunch of different traditional products, so they actually have a lot of capacity there. And these guys have a whole bunch of traditional products, so a lot of capacity. So their capacity says those guys are really attacking, in that sense from a capacity standpoint. And the rest of these guys, from the standpoint of traditional, are kind of holding their own. In terms of low end, sort of the same story as everybody else. They're kind of in that range, so you can't really tell anything from that. When we look at the high, and they just have the one product, they're at 850. These guys are at 800, high 900. They don't have any. These guys are at 750. So, they might be, I guess what I would say is, they're sort of keeping up with everybody else in terms of that. The performance is probably a little bit higher simply because they have 2 products there. But if we had to put that, we'd probably say they've been increasing or keeping up in most segments, but not like really going crazy. So really, what you're noticing is they're increasing in all segments. So they could be any of these. So then customer awareness and accessibility, you're looking for whether they're at the lower or higher end and whether they're that across everything or only across certain things. And for that, you have to actually go look at each of the products separately. So let's look over here at their customer awareness and in the traditional segment. And again, we're looking at D, so that's days. 73%, that's a pretty high customer awareness. There are some that are higher than them, but you had to spend money to get to that awareness. You can see they're spending a decent amount of money. Accessibility, maybe not as high. They're just sort of, in the pack there. So not sure what you can infer from that. Low end. Let's see, we've got the Dell products, 72%. One of the higher folks in terms of awareness. 47%, one of the higher people in terms of accessibility. So they're spending there. Let's see, the Dixie is 71%. Kind of towards the high end here. 53%, maybe not quite as the high end. So they seem to be spending a lot on awareness and maybe not on accessibility as much there. 69%, one of the top people in customer awareness for the products that are really squarely in that segment. I don't know if you realize this, but sometimes you're picking up products from another segment that are just sort of out in the periphery of yours. And we don't pay attention to those because those got picked up simply because you didn't produce enough goods, possibly, with the main products. So we're really focused on these ones that have substantial percentage. So in that, they're kind of towards the top of everybody. Look at performance, same sort of thing. We're really only looking at these three. And let's see, they're at the top here. So top here, top in this one, in performance and size. Let's go look at that high end again. Again, and we'll kind of cut it off here. They're at 71%, and so that makes them the second highest in that kind of cohort. 53%. There are others higher than them there. Do the same thing here. Just kind of go back and look at it again. Really cutting it off here. But the Dell products at 72. There's only one higher than them there. If we look at the traditional segment and kind of cut it off right around, it's always harder to know where to cut this, but let's just say we're going to cut it off around here. Again, they're at 73%. There are some others that are a little bit higher than them. So, really the question is, what can you infer from that? A little bit harder to read, but what we would say is they're certainly not at the lower end of the segments. I think it's safe to say that they're towards the middle or the high end. That's in all segments. They're not at the lower end. It's not, you wouldn't say they're at the higher end of only some segments, so not that. They're actually towards the higher end in traditional and low, so it doesn't fit that. And doesn't fit that. So really we're looking at that. So when you put it all together, and I'm going to just shrink this down just a little bit so you can see everything. And it's hard to see the words. But when you put it all down, it kind of looks like the pattern emerges that most likely they're either a broad differentiator or focus. And when you start looking at, kind of the things that set you out as focus, that you would have, for example, MTBF consistent with customer preferences. You'd have price consistent with customer preferences. They really fall short on those things that a good executor of a focus practice would use. So I would guess they're a broad differentiator. Now, the idea behind this is that now that you've said that, or you believe that they're a broad differentiator, you can sort of think about what a broad differentiator is likely to do in the next periods. And so, what you would expect is that they're going to continue to be aggressive on their marketing. They're going to continue to be aggressive on their positioning and their MTBF. They're not going to have revision dates that go a long ways. They're not going to be repositioning any products. So the products you see aren't moving to other segments. They only have 6 products so far, and they need to have a total of 8. So they're likely going to be adding products into some segments. The most likely segments usually for that are the performance, size, and high end. So you might be expecting them to put some in there. And really the big thing, if there's a competitive side to this, comes with the fact that they're not going to be well matched, right? Since they're a differentiator, they're going to be a not good competitor in the low end. So again, if you kind of went back up here, saw how they're doing in terms of the low end, what you would expect is, decent market share here, still kind of high priced, probably have that market share because eggs stocked out. Okay. Again, there's a couple other that are higher priced than them. Remember that it's basically age and price here, and that what you're effectively looking at is some combination of revision dates, all that sort of stuff. Really, the tell for you in terms of how they're doing, they're ranked at a 35 right now in traditional against a 42, which is what everybody really wants. That's the best one out there. So they're not doing bad yet, but you would expect them to stumble. More importantly, if I'm looking at them and saying, I think they're really trying to be a differentiator, I'm going to, number one, start to target the lower end of price. Number two, I'm going to kind of keep my age in the range and not worry too much about having the very best spec. You can see that they're really getting out ahead of people in terms of both performance, and their size is getting a lot smaller than most everybody else's. And so at the end of the day, they're spending a lot of money and a lot of time moving those things. When in fact, if we're not quite as concerned in the traditional with being quite on spec, we're more concerned with age, then you can maybe move that thing once early on and let it sort of age out, get a little bit older, and be in a better position than them. So if that's what you think they're doing, then you can take share from them in that way. The low end, let's see kind of how they're doing as well. Again, not very much in terms of their percentage. I mean, they're okay, but they're not great. They seem to be really hovering around the top end of the price. It's just not a very, if we look at the range of prices, $13.50 to $23.50, right? And they're at 21. So they're not super aggressive on price, but they're towards the top end. So if you really want to take share from them, you can see that the guys with the lower price have taken share from them. Nobody's moved their spec yet, so they're not getting killed in terms of that. What's probably more telling for them, and I will go up here and look at that, is because of their spending. Let's look at something slightly different. So their contribution margin's 31%. These guys are at 34, 38. So quite frankly, doing quite well in the traditional. I don't know what's going on with these guys. 32, 30, 14, a little bit low. So they're doing okay on that. Low, they're at a contribution margin of 43, 46, 42, 43. I'm sorry, did I get it right? Yeah, 33, 38. So surprisingly, they're still doing pretty well on that. What I would expect is that the rest of the market's going to pick up on this price pattern and start undercutting them on price, and you're going to start to see some of their position eroded. Flip side of that is they should be doing pretty well on high-end performance and size, and so you might actually see them getting kind of aggressive in terms of that and doing well. You potentially, in that case, would not necessarily enjoy going head-to-head with them on those segments. So anyway, that's sort of an example of what you could do. I leave it to you to do this same thing with each of your competitors and be able to come to class and tell me what you think, what strategy you think each of your competitors are likely pursuing, and what the implications of that are. That is sort of the first step to feeling like you're getting ahead in this strategic management of the CapSim, as opposed to sort of just reacting to what's happening. So hopefully you find that useful, and I appreciate you guys' time.